Hello and good morning, listeners. A very happy and a blessed new year to all from your folks at Almus. This is Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. And joining back in with the festivities almost done, but it seems that the markets are not yet done with them. Diwali festivities now in financial markets with significant moves across asset classes. Japan is going strong with interventions and also talking about stimulus packages while dollar slips on these interventions as well as the rollback of policies and the politics in the UK. We also have the Chinese interventions while we see European Central Bank coming up with their decisions on the rate hike today. On the backdrop, oil also continues to have their gains. So there's a lot of things happening in the financial markets, DK. And with so much actions, what should we be looking and expecting in the financial markets?
Hey, good morning. Happy New Year to all. Actually, it's been a relief rally across markets in globally that we have seen. First of all, on Monday itself, we have heard about whispers of Fed looking to discuss the quantum of rate hikes after the November meeting, and that got a further boost when there were quite a number of data points that came weak in the US, including the PMI survey by S&P, where the services sector showed a big drop. Then housing prices had a big drop. Richmond Fed National Activity Index showed a drop in the manufacturing as well as the services index. US trade data showed a big jump in the deficit, and all these actually then supported that the earlier talk that Fed might be closer to a pause, even not just considering a lower quantum of rate hikes, and possibly the effect of hefty rate hikes in the past several months is starting to have an effect on the economy. That is how it is being interpreted. That resulted in big rally in the bonds, which means yields were lower. The other factor was, in fact, the Bank of Canada meeting yesterday threw a surprise by hiking just by 0.5% instead of widely expected 0.75%. And this was again read as sign that the central banks may be, reaching maybe much closer to the end of their rate hiking cycle. Again, that boosted the bonds as well as the equities and also the currencies against the dollar. But for me, the most significant development in the market has been the drop of 10-year yields below 3-month T-bill rate, which is now 4% versus 4.06, and this is considered as the Fed's barometer of recession. It's a rare occurrence that signals investors anticipating dire economic consequences of Fed's campaign against inflation. And even the most widely followed Wall Street Journal columns highlighted this fact. And the data shows that this inversion has preceded almost every US recession, barring 1967, then when there was a false signal. So since 1950, every recession has been followed by, he's been preceded by the inversion of curve between 3-month rate and 10-year rate, and Fed is definitely glued on to this type of inversion. So that's again a factor which helped the yields fall. In fact, before that, let's also look at the confidence coming out of UK. Stability in the UK markets after PM being chosen. Mr. Rishi Sunak has actually created kind of investor confidence in the UK, which is reflected in all the segments of the market. Pound has rallied almost 12% from the all-time lows of 1.0380. The gilt yields have had a staggering fall of 107 basis points after the peak that was seen post mini budget presented by the previous finance minister. And UK stocks have also been rallying. The fiscal plan, which the new finance minister, Mr. Hunt, is supposed to present on 31st October, has been postponed to 17th of November. But again, it is, being said that this is to have a comprehensive look on a long-term basis. And again, That's been taken as positive sign. Now the terminal rate in UK, which was hovering around 6, is now down to 4.9%. And that's again a sign of investor confidence. So all in all, Fed expectation of closer to being a put, and then economic data confirming, Bank of Canada moving lower, and UK stability. All these have led to rally in the currencies and the bond prices as well. The 10-year yield in the US has fallen from 4.34 to 4, and 2-year from 4.62 high seen to 4.38 yesterday. German yields, which had hit 2.53 last Friday, have fallen to 2.11%. Now, the remaining 2 days of the week, we will have several important economic data and events, to which the current sharp moves may see some retracement. The first reading on the US Q3 GDP is expected to show 2.4% versus a negative growth seen in the last quarter. Tomorrow, we will have the preliminary inflation number from Germany, as well as the PCE core prices from US. Both of them are expected to show a higher number on a year-on-year basis, but moderation in the month-on-month numbers. Again, these are closely to be watched for future, Fed policy. And on the policy front itself, we have the ECB rate decision today at 5:45 p.m. IST, with the consensus expectation of 0.75 rate hikes. But interest will be surrounding ECB President's press conference that follows for clues about future rate moves, as well as plans for reduction of the balance sheet. Also, on the policy front, we have the Bank of Japan rate decision tomorrow, with no expectation, obviously, for a rate change, but will be closely watched for BOJ governor's press conference for clues about yield curve control, even as the inflation in Japan has been steadily rising. But as the PM as well as other authorities in Japan have indicated, they are giving more importance to the wage price rise, and any rate hikes will be linked to that. So currencies, we have seen more than 5% rise in the euro. As I said, 12% rise in the pound. And then this sentiment was also used by the Bank of Japan to intervene once again at around 149 levels, and we are down to 146. And surprise move was from Chinese authorities, who sold dollars through the state-run banks after the offshore yuan hit nearly 7.37 and came down to as low as 7.17, now back up at 7.22. So I think much of the moves in the currencies are down to the positioning in the market, because market has been buying dollars now for well over a year in major currencies. Chinese yuan has been weakening from early this year, and at some point investors do tend to take profit, and as we move towards an inflection point for the policies by the major central banks, it's only fair that they take some profit. But in reality, we don't have any evidence of inflation coming down, or even Fed statement saying that there will be any pause or lower rate hikes, but it's all down to speculation and positioning in the market. On the rupee as well, we have seen some sympathetic strength in the rupee, which is unlikely to see sustainable gains without the flows or deficits dropping. For rupee to participate along with the fall in the dollar index, firstly, we have to consider whether there's any fundamental change. No, nothing. Deficits are still high. There's no sign that it is dropping. We do not have signs of large flows so far. And the largest seller still remains the central bank, who meets the deficit in the demand versus the supply. Is there any large, time-bound pent-up flows? There are no signs, but we may have to see if it is emerging in the next few sessions. And also, is dollar rupee overbought? Unlikely, because dollar rupee is not a convertible currency like the majors like euro or pound, where the markets can go to the extremes. They did go to the extremes. 1.03 all-time low in pound, which was last seen in 1985, and euro well below parity, dollar yen moving close to 30% higher. So these are a reflection of markets where there is a free hand to the speculators and they are able to determine the price depending on the market demand and supply. But that is not the case with the USD INR. So we do have, very low proportion of the market which is on a speculative basis. And we also know that by historical measures, the importers in India remain underhedged. So overall, if you look at the structure of the Indian rupee, we are not definitely not long in the USD INR. It may have some short-term impact, but for it to have a sustainable move lower in the USD INR, we need to change. We need to see change in conditions, in the financial conditions globally, probably easing of yield, much more easing of yields, and then liquidity flow to EMs to restart. One thing I can say, while we may not have much flow into the stock market, if there is a hint of yields topping out, including India, then we may see large flows into the Indian bond market where the FIs are positioned, at a much lower quantum, as well as the long-term FDIs may also start. But again, these depend on how the global financial conditions pan out in the coming days. For now, I think 8150 is very likely to hold on the downside. We may well see a lot of importers taking advantage of any dip below 82 to cover their positions. Exporters may again wait because the premiums are not very attractive. So unless we get back to around 83, we may not see much selling by the exporters as well. So looking at 81.5 on the downside and 80 to 80 on the upside for the next few days. Importantly, today we also have the futures settlement for the month of October, which may see more intraday volatility. Thank you.
Okay, wonderful, JK. I mean, you have covered so widely the markets. I mean, I'm still, somewhat awestruck. But I'd like to highlight certain things, folks. The 10-year yield, which JK mentioned, has been a widely followed indicator for recession, has inverted against the T-bill, whereas the Canadian central banks have put some brakes on the rate hike cycle with only 0.5% as against the 0.75% of rate hikes. And this has been one of the reasons for, some sort of a relief rally. One of the reasons for the relief rally, as a poor macro data on the US side was more of a supportive of the whisper around about the breaks in the aggressive rate hikes. Other than that, we see terminal rates in UK coming down to 4.9% from 6%, which is a definite and a very big change in the investor sentiments. And we also await the ECB update. But finally, on the domestic side, yes, the fundamentals still remain more or less same. But if, as JK mentioned, the yields start topping or looks like topping, we might get some good flows coming in. So there is still a lot of things going on in the markets, and we shall continue to bring you all the updates which are there in the financial markets for you to add. That's it for today, folks. We shall join in again tomorrow. Thank you so much for listening.